Well, you got to be flipping my flapjacks, folks. We have some very, very interesting things going on in this market that we have not seen in years. We have so much to speak about here today, why certain things are happening, why certain stocks are starting to climb, while others are faltering. We got some earnings to go over. We're at the infant stage of earnings season. Two very important stocks actually reported earnings. I want to take you through what's going on in their business model. A lot of people feel like the high-end consumer is in a great place. Well, we're going to find out from a very specific company, one of the most famous high-end companies in the world just reported earnings. Going to take you through what's actually going on with the high-end consumer. Talk about where opportunities are in this market. Talk about some things that are coming here that you need to be prepared for. Okay, appreciate everybody joining me. As always, so much to go through. Busy video, folks. I appreciate y'all being subscribed to the channel. As always, lots to get into. So, small cap stocks. If I looked at my best stocks here today, they were the smallest cap companies, the forgotten stocks that have been beaten down for over 2 years at this point in time. Stocks like Avant was up 15 percentage points today. 15 percentage points. Fubo was up nearly 7% here today. The Planet was up over 6% here today. And, there was just a lot of small caps were climbing today. Small caps have been just devastated for over 2 years now at this point in time, literally over 2 years. Matter of fact, if I was to pull up the Russell 2000 over the past 3 years, so if we went back to this day 3 years ago, you would find that basically the Russell's gone nowhere the past 3 years, which is pretty crazy to think about, right? It's been a horrible time. But there's some certain flippening happening now at this point in time. And so why are some of these stocks getting rolling a little bit? I'll show you exactly why. Well, treasuries actually were all down across the board. 1 month treasuries down, 2 month, 3 month, 6 month treasuries. So all the shorter term treasuries all down here today. 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, and 30 year all down. And the big substantial movers down was 3 years, 5 years, 7 years, and 10 years. Okay. Now, here's why this matters so much for small caps, right? If there's a belief that rates had peaked, then ultimately small caps are going to boom, right? It's pretty much as simple as that. If rates have peaked, then small caps boom. Now, that does not mean rates have peaked, right? We could still be in a cycle where rates go even higher or something like that. But if you're of the belief that rates have peaked, guess what's going to boom? You're going to see money flood into small caps like nobody's business, and you'll see just tremendous moves in very short amount of time if rates have actually peaked, right? You look at a stock like Avant, that 15% move, keep in mind, Avant's basically flat on the year, right? And I can tell you, if it wasn't for rates holding back these sorts of stocks, this stock would be tremendously higher than it is today when you would look at the actual numbers, right? The revenue's skyrocketing for the company. Net revenue was up 82% in the first half of the year versus last year, right? As far as if you look at gross margin before fair value adjustments, up 197% year over year, this first half versus last first half. Operating expenses have actually gone down for the company, and net income is getting very close to profitability versus last year. At this time, they were taking massive losses. So you look at a stock like that, the bottom line is that stock would be tremendously higher today if it wasn't for the fact that treasuries have held back these stocks in a substantial way. And it goes for all these small caps, have just been held back in the biggest way. Fubo's had a good year, 43%, but I could tell you this stock, if it wasn't for treasuries holding this back, this would be 100% to 200% gain year to date right now. It could be up so much more based upon their subscriber numbers they've been putting up, based upon how great a strides they made in terms of profitability and getting, let's call it, in a much better financial position now than they were certainly a year ago. If we look at, obviously, the biggest Google trends we've ever seen in history for Fubo just last month, this stock would be 100 or 200% gainer easily right now. But treasuries have held back all these stocks in a tremendous way. You know what else treasuries have held back in a massive way? It's these stocks right here, right? Dividend payers, stocks like Target, stocks like Cheesecake Factory, stocks like Nordstrom. These aren't the most exciting companies in the world. Let's just be honest, okay? Target, Cheesecake Factory, and Nordstrom. But these represent incredible value in this market right now, right? These are no Fubos or Avants that have ridiculous revenue growth and all that stuff, but these are as solid business models get, right? They put up their numbers, and ultimately, you hold these stocks over a 10-year span, you're usually going to do very, very well for yourself. But these stocks have been horrible. And the reason being, once again, goes back to treasuries. If treasuries keep going higher, people look at that and they say, why do I want to hold Target? So what, I can get a 4% yield and get 5% on a treasury, right? It's as simple as that. But the moment you start to believe, maybe treasuries are starting to peak or in a peaking cycle, that's when money starts flooding back into dividend stocks. That's when money starts flooding back into some of the small cap stocks and things like that, right? I looked at the public count here today. It was a mid-day for the public count, so it was up $22,500. And I know, that might sound like I'm complaining. I'm certainly not complaining. Like $22,000 in a day is $22,000 in a day. But based upon kind of some of those moves I saw with like Avon, Fubo, I would have thought it would have been a better day for the public count. But here's what's going on. It wasn't a day for like these sorts of stocks. These stocks all did okay. Like the biggest positions, right? Meta was up 1% today, so $6,300. Tesla, $6,500, 1.5%. Amazon wasn't even up 1% today, so I was only up $1,200. Elf on a Shelf, 1.5%. Palantir was up 1% here today. So this wasn't one of those sorts of days. It wasn't like one of those days where it's just the playbook of 2023, hide in the big caps. This was a different day, okay? And so you can't ride too much from this overall. You can't say, well, just because this happened one day, we're for sure small caps are going to boom. You need to see several trading days in a row like this, if not a week or two. You get that sort of trend, then you're kind of in, oh boy, we're about to go real bull mode. You're going to see the equal weight S&P 500 catch up in a massive way if we're to see a truth in treasuries kind of basically peaked. And we'll see. That's dependent upon so many different things. But you know what's interesting? I was looked at some of these other stocks that have been just slaughtered. And even some of these are still getting hammered. Campbell's Soup was down almost 1.7% here today. On a green day for the market, a lot of dividend stocks having a great green day. Campbell's Soup can't get out of its own way. It's now down over 30% this year, right? General Mills, the General, down over 1% here today. Down 26.41% year to date, General Mills stock is now, right? And when it comes to a lot of these stocks, you just got to keep in mind, okay? Tax loss harvesting into year end, that's going to be something that holds back, in my opinion, a lot of these dividend and value stocks, even if we do get a Santa Claus rally. Many of these sorts of stocks that have been slaughtered this year will not perform nearly as well as they could have. And the reason being is a lot of people are going to take losses. I can tell you there's going to be a lot of funds that take losses on these stocks. There's going to be a lot of individual investors that are going to do some tax loss harvesting. And especially if you've sold any of the big techs for big profits this year, which I know there have been. There's been a lot of people that made a lot of money in Meta or Nvidia, AMD, Apple, Microsoft, Amazon, Tesla. A lot of those stocks have boomed this year. There's going to be a lot of people that are going to take some profits in those stocks or already have taken profits. And they're saying, do I want to pay tax on that, or would I rather offset it by selling some of my General Mills stock over here, right? And you amplify that by all these funds and whatnot. And some people say, let me just go ahead and tax loss harvest this baby, and I'll buy it back, next year at some point in time, right? So that's something that will hold back these stocks. It doesn't mean these stocks can't go up. It doesn't mean that Target can't go up. It doesn't mean that General Mills can't go up, or any of these other stocks for that matter. It just means you're not going to get nearly as much as you could have if you wasn't for tax loss harvesting. Because I guarantee you there's going to be tax loss harvesting going on, right? Now, we've heard recently things like, well, the consumer's been really hit by inflation for the folks that make under $100,000 a year, right? And if you think about who inflation hurts the most, it's folks that make under $100,000 a year, right? If you make $50,000 a year and suddenly gas prices are substantially higher, food prices, that's hurt you substantially, right? Your real wages could have gone down, and that's what we saw for about 2 years. But what's held up the economy pretty decent is the folks that actually make good money. Let's call it the top 10% of income earners, the people that make $200,000, $250,000, $500,000 a year. Those people have really helped keep up the economy and keep this kind of show going, right? And so you want to pay attention to what's going on with those folks. And are there any trends that are going on in regards to these companies? Well, there's a company we can get a lot of data in regards to that. Company's name is LVMH, Louis Vuitton. So Louis Vuitton owns all these high-end brands that really cater to folks that are making hundreds of thousands of dollars a year in income or millions of dollars, right? This is their customer base and around the world, right? Well, they just came out with earnings. And are we getting any signs that the higher income folks are cutting back in a substantial way? Here's what's going on. Right off the bat, I go to their investor relations page and I find something very suspicious. Very suspicious, folks. Organic revenue growth of 14% in the first 9 months of 2023. I said, wait a minute. No one ever talks about a headline. The headline number for the earnings is the first 9 months of the year. That's not usually what happens. People talk about the most recent quarter. In the last 3 months, blah, blah, blah. Sometimes you might talk about the first half of the year, second half of the year. First 9 months, I said, they're I don't want to say hiding something, but they're trying to give an illusion of this 14% growth number, which is a truth for the 9 months, but this as soon as I saw that, I said, there's got to be weakness in this business model recently. There's got to be weakness. There's no reason you would put that on there unless there's something going on. So I looked a little deeper. And what did I find? I found the third quarter numbers, and I found considerable weakness just compared to the first half of the year, okay? So in the third quarter, wines and spirits business for them, which is a pretty substantial business for the company overall, they own a lot of wine and spirit brands, that was down 14% year over year. Fashion and leather goods was up 9%, but the first half of the year, that number was up 20%. So there's an insane deceleration going on at LVMH, right? Perfumes and cosmetics was up 9%. Well, guess what? The first half of the year was up 13%. If we look at watches and jewelry, that was up 13% first half of the year, only up 3% now. Oh boy. And selective retailing was basically equivalent. So overall, if we look at the first half of the year total, let's call it revenue growth, they were at 17%. Now they're at 9% for the third quarter, which shows that there's some real weakness starting to come in LVMH, which kind of leads to a little bit of like recession worries and those sorts of things. Now, what I can say about that is you can't call it a recession until you really see a company like this go negative. If you see this company's revenues go negative next quarter or the quarter after, then you can really talk about, okay, we're in recession. But for right now, 9% growth is still very healthy. Like if LVMH can grow 9% year over year for many years to go in the future, like they'll take that. That's good growth. That's good growth. Is it 17%? Heck no. But 9% is still solid growth. It's just not nearly what the growth was just a couple quarters ago for that matter, okay? So that's something very important to pay attention to. And that leads me to Estee Lauder. Estee Lauder stock, despite the green today, was actually down. And, pretty much right around, a fresh close low for the stock. That stock's been hit hammered this year, almost 47% down year to date. It is a stock I'm interested in potentially buying here soon, but there's no doubt that stock's been hit hard, but it's a high-end brand. All their brands that Estee Lauder owns, Estee Lauder is kind of almost like an LVMH, but in the cosmetic space, in the perfume space, and colognes and things like that. And for them, I could tell you, their business just hasn't been as strong very recently, and they've seen a big pullback, and so they kind of fit in that LVMH category. Something fascinating here. If you look at Estee Lauder stock, this is crazy, okay? Because this stock's peaked right when my opinion of the wealth effect peaked. The wealth effect peaked basically in the fourth quarter of 2021. And then we kind of started to have this decline of the wealth effect happen over the past 2 years, okay? And so literally right when that stock peaked, it was right when the wealth effect peaked. Right after that, everybody started talking about interest rates going up, and then the wealth effect died down into, where we are today. So fascinating to kind of keep track of these high-end brands and to see what's actually going on there. Now, while I was preparing this video, I had Fast Money on my phone, right? And all of a sudden they have Steve Eisman on, the Big Short man. And so they ask him, a bunch of different questions, but one of the questions they asked him, where would you not invest right now in this market? And he says some very specific places. He said one is housing stocks. He basically said housing, don't want any piece of housing, right? So that would be the companies like the Tolls and the Centuries and the KBs and all the NARS. Those sorts of companies would definitely fit that criteria of housing stocks, right? And why not? Well, he basically said, mortgage rates are obviously substantially higher than they've been any time in recent history, right? Look at this. The average interest rate for a standard 30-year fixed mortgage is 7.93% now, which is growth on 19 basis points compared to 1 week ago. I mean, here's the deal. If we can see Treasury starting to cool in any significant way, we could potentially start to see mortgage rates fall, let's call it in the next few months. But in order to get these mortgage rates down in any substantial way, we really need Treasuries to pull back in a major significant way. And I wouldn't get too confident about a massive pullback right now, okay? So, and I don't know if you guys saw here today, the home builders, okay? The home builders, the National Association of Realtors, and another group of individuals, they all sent a letter to the Federal Reserve today. They sent a letter to the Federal Reserve. And basically, they're begging the Federal Reserve not to raise rates anymore. They're saying, please stop raising rates. Now, what I thought was interesting was I was curious because I was like, are they begging them yet to lower rates? And I didn't really see any of that. It was more just begging, please don't raise rates anymore. Please don't raise rates. You've done enough, these sorts of things. And so if you get to the next stage is a situation where all of a sudden these folks start to beg the Fed to lower rates. That's when you know you're at a whole different scary level. You're at a scary level, and that's when you know you're pretty much at a bottom of a cycle. When folks are begging the Fed to lower rates, please. And he also basically said, you really don't want to buy any of the autos right now, which makes sense. Look at this, guys. Look at the chart I got in front of you right there. Interest rates on a 60-month new car loan in the United States. I mean, we went to the moon. It's skyrocketed in the past 18 to 24 months. Literally skyrocketed. And so it's not a good time for, obviously, home sales, auto sales, and things like that. These babies will come back. Auto sales will return. Home sales will return. It's just not today. And it's important you understand, where the opportunities are in the market and where are not the opportunities in the market. And the scary part for these sorts of companies is whenever the Fed does start to lower rates, it's usually because you're in a little economic weakness during that time, right? And if you're in economic weakness during that time, well, then you're likely going to still see less auto sales and home sales during that time. So there is a little food for thought there. And that's why you really got to understand where the true opportunities are in the market versus, let's call it, not as good of opportunities in this market, okay? A lot more to go through, obviously, in today's video, folks. But I know a lot of you guys don't understand income statements, balance sheets, cash flows, how to value stocks, if you're getting a great deal on a stock versus a bad deal on a stock, how to run your portfolio properly, any of that stuff. My Financial Fortress program goes into all of that. It's pinned comment down there if you want to apply for that. It's tremendous. There's a reason we've had just a ridiculous amount of people be able to scale to 6 figures, 7 figures in the market over time. You've got to get your education up and know what you're doing in this market, know where the best opportunities are, or you'll be left behind in the end, and you don't want to be left behind. So apply to join us in there. That's pinned comment down there, okay? Now, Pepsi earnings came out. Pepsi earnings were freaking good. Very good earnings, okay? Net revenues grew by about $1.5 billion roughly on a year-over-year basis. Check out the gross profit of PepsiCo. Oh my gosh, okay? It went from 11.6 to 12.7 gross profit, $12.7 billion. That's a booming number. Operating profit went from 3.3 to over $4 billion in operating profit. Boom, okay? They did have a big tax expense, certainly, in the quarter, so that kind of hurt them and held them back a little bit. Net income still came in at a very impressive $3.1 billion versus $2.7 billion in the same quarter last year, and keep in mind a lot of that hit was from taxes there, okay? EPS came in at $2.24 versus $1.95, so PepsiCo earnings looked very good. I know there's all this fear about weight loss, pills, and how that's going to affect companies like Pepsi and Coke that own a ton of brands, because you got to understand these companies own massive amounts of drink brands, snack brands, everything like that. And the thought process is, people are going to start taking these pills, they're going to have less Pepsi-related products and Coke-related products and all the snacks and all that stuff, right? We'll see where it all plays out, but at least in the numbers as of right now, we're not seeing it. Now, PepsiCo stock didn't really do much here today, guys. It was up less than 2%. So despite the really good earnings, Pepsi, I don't personally own the stock, but I will say, would I feel comfortable holding Pepsi for the next 5 years? Sure, I would. There's no question about it, right? Netflix stock was down over 3% today. Whenever I see markets green, a lot of green activity out there, and then I see a stock down 3+%, automatically my brain says something happened. Why is that stock down so much? And especially for let's call it a company that has a lot of trading volume on a given day, which is certainly Netflix. And it was hard to pinpoint exactly what's going on with Netflix and why that stock was down over 3% today. There's a few possibilities. One is I saw this article said Netflix stock drops as streaming service sees lowest subscriber growth in UK in years. But then when I clicked on the article, it referenced basically the 2022 numbers, which I thought was weird. Why are we referencing 2022? That's in the past. So could be that. Also, I saw this. Netflix reportedly acts as free mobile plan in Kenya. You might say, well, what does that even matter? It could matter if you're talking about the subscriber numbers. And, these subscriber numbers, everybody pays attention to them closely. It is something that matters for the stock. And even if you were to throw things off a few 100,000 subscribers, or certainly a million or two, it does have ramifications for the stock price, because people say, oh my gosh, the subscriber growth isn't there, right? And then I saw this Hollywood Writers Union ratify new labor contract. The cost of doing business could be going up quite a bit for companies like Netflix. There's also was a rumor today about Netflix maybe wants to get into sports. I don't know about that, man. Sports is extremely expensive, and I just don't know if Netflix really wants to go there. From what I've heard on conference calls, they don't sound like they're interested in sports at all from the perspective of live sports. Sounds like all Netflix wants to do in regards to sports is documentary type stuff. And those sorts of vibes. It doesn't sound like they want to have live sports. They could change their mind over the future years, but it just doesn't sound like what's going on there, okay? PayPal. Got to talk about PayPal. So, what's my feelings on PayPal, right? The stock just continues to be in a very weakened place, okay? My opinion of PayPal is we're going to roll in 24. There's no doubt in my mind that 2024 is going to be a great year for PayPal stock, and we're going to have quite a rolling year. And I think it should be a tremendous year in 2024, especially as, Mr. Chris gets involved, in terms of the conference calls and all sorts of things over the next few quarters, investor presentations and conferences. I think that's going to help tremendously. And I think we're also squeezing the last bit of sellers out of the stock. Like, if you haven't sold PayPal by now, what are you waiting for? This is like, you've had an opportunity here to sell for basically 2 years. There's been constant selling in the stock for basically 2 years. This stock peaked around August, we can call it, of 2021, and it's been constant selling for over 2 years, right? But we're forming like this beast bottom in the stock that's been kind of forming for the last, year or so. And there's basically two recoveries you see with stocks, which, I believe there's going to be a substantial recovery when it comes to PayPal. And what happened with Meta is not PayPal, right? Meta, I get a lot of similarities between what's happened with PayPal recently with what happened with Meta, but Meta was a V-shaped recovery. I'm not necessarily, in regards to PayPal situation, it's not a V situation, okay? Could be more like a W situation or something like that, okay? But that's sometimes a recovery you can get where it's just straight down, straight up. That was Meta, okay? You can also get, this is the type of recovery I'm expecting for PayPal, very similar to what's happening with Palantir over the past few years, right? Where Palantir peaked at the very beginning of 2021, right? Very beginning of 2021, and then was just down and out from there. And basically it took up the stock about 2 years or so to bottom. And it formed a big bottoming formation kind of in that $5 to $9, $10 range for basically about a year. That's where it was at. And then obviously we started to climb, from where we started the year, which was $6 a share or so, to now we're closing at 17. Who knows, maybe we were 20 plus by the end of the year. But very similar, I think, is going to play out here with PayPal in regards to this. I think this is very Palantir situation in regards to the recovery of the stock and kind of everything I see playing out there. What's happened with the business and the valuation, everything like that, reminds me much more so of Meta. But in terms of stock price, it reminds me much more of a Palantir situation. I think, my confidence is not wavered at all in regards to PayPal. If anything, it's more than ever. Now, I saw this, which was very important, right? Because I know we've all talked about inflation and how the effect it's had and things like that. This is interesting. This is U.S. inflation aggregated by Truflation, okay? And basically since October 2020, basically 20% plus, okay, is what the aggregated number is. Because I know we always pay attention to like the monthly numbers, and it's up 9% year over year, 2%, 3%, 5%, whatever. The aggregated number matters in such a substantial way because it really lets you know like what's really going on, like how bad have we really gotten hit over the past few years. Now, what's fascinating about that, remember that 20% plus number there, because the S&P 500 in the past, we can call it 3 years or so, is up like 25% or so. So we're in this fascinating time period where the S&P 500 has really had trouble even keeping up with inflation. Think about that for a moment. And so there's always like debate about index funds versus stocks. And I understand like if people don't want to put in the work towards stocks, like index funds, like that's the next best thing. But like to be an individual stock picker, pick 10, 15, 20 stocks and invest in those stocks and build out a beast portfolio, it's just going to pay over time versus this like, I just have a hard time like being in something that basically is barely keeping up with inflation. That's not going to do it for you. You're not going to retire on that. If you can barely keep up with inflation, like how are you going to retire? Like that's just crazy to me, right? So anyways, that's just something I think is very important that people pay attention to. Is if you're thinking about keeping up with inflation, man, you've got to do something better. If I look at the public count, right, and these are the returns calculated by Fidelity Investments on what we've gotten over time. Time-weighted rate of return over the past 5 years is 22.7% per year, right? If we look at money-weighted return, we're at about 17.49% per year over the last 5 years, right? This versus S&P 500's at 9.9% per year over the last 5 years, as versus the Dow's at 9%. The U.S. aggregate bond index, which is what a lot of retirees are in, okay? A lot of people in their 40s, 50s, 60s, 70s are in this. The bond index is basically flat in the last 5 years. You've basically got no gains in the bond index in 5 years, folks. That's a disaster. That's not good for retirees, okay? This stuff's not cutting the mustard. And that's all I got to say about that. And you think about, I made so many mistakes, so many screw-ups in 2021 and gotten so many bad stocks in the public account, and I still am absolutely killing the market in the public account. And it's not even close, right? And I'm wrecking the bond index and everything across the board, the Dow, S&P 500, right? And that was with countless mistakes and just being completely in a delusional state in 2021. And it's still killing it. So, this is where you got to level up and take this stuff to a much higher level. And imagine if I didn't go crazy in 2021 with all this stupid stuff I was getting in. Like, could you imagine what my rates of return would be today? Oh my gosh. I'd probably be sitting on 30, 40, 50% gains per year over the last 5 years if it wasn't for all those screw ups I had during that year, right? Think about that for a moment. Let that sink in. Like, oh my gosh. So, folks, this is food for thought here, and this is why you got to take this individual stock picking game pretty darn serious, okay? Know what you're doing in this game because this ain't going to cut it. This ain't going to cut it. That's all I can tell you about that, okay? And then you look at my returns in the public account, and you think about all the screw-ups I had, and I'm still getting that? You're going to tell me you can't do this game? Come on, man. You can do this game, okay? Appreciate y'all joining me as always. Make sure you apply to join my private group, Financial Fortress. Get yourself up to a much higher level than where you're at right now because you're going to need it because, there's a big difference in what you can get versus what you're getting out there, folks. I appreciate you joining me. Much love as always. Videos coming for you. About to get in a fun earnings season, baby. Earnings season is here. We're at the infant stage of it. It's about to get very exciting. And have a great day.